Good day, everybody. Welcome to another video. I wanted to just lead with this really important screen. This is the options chain data. It's part of the Trader Workstation or TWS. This is for a NG or a natural gas contract with the options chain data. I've talked about this before in the previous video. This is going to be part of my analysis for a professional institutional level reporting system that will lead into a trading system. And I wanted to show you how valuable this data is, okay? Because essentially, put up my last video on how expensive to get access to this type of data from a programmatic standpoint. You're ranging between 2 to 4,000 per month with a 1 year contract, with also the licensing fees on top of that. So this is a typical option chain data, which is very valuable. You cannot at all copy it anywhere. Okay. So as a result, that means you can trade it manually by eyeballing it, as you can see here. But to try to access it through an API, I'm pretty sure it's not possible. I've been keep asking people, if you know a way, let me know. Let me know the code. And this is for not options on stocks, not options on equity. This is options on futures or future options. Okay, big difference, because I can get stock options working no problem or equity options no problem. So again, for natural gas, you can see here we've got calls, the puts, all the important stuff. We've got 0 day to expiry. We've got 3 day to expiry. Because I'll let you watch all the videos out there in the world on how to run this, but from my perspective, I just want to show you this is the valuable nuts and bolts of options trading, especially when it comes to futures. And the reason why this is so expensive is because this is how the exchanges monopolize this type of data, and it's really exclusively only available for the big institutions that are probably in the $1 million size accounts. So us retail traders won't have access to it. So the only way I can get around this is by eyeballing this. So as I've started doing this now, what I had to do was I had to put an asset in of the underlying contract, the futures, and then from there I have to build out all the parameters that would go into a typical options system based upon me having to input this data manually. So here we're dealing with, and remember, I'm just starting out here. So we're dealing with contract size, futures entry price, long call strike price, long call premium, long put strike, long put premium, so on and so forth. And in fact, because I can't get the data out of the option chain through TWS and through Interactive Brokers API, I have to manually put some pricing in here to generate what I want to show. Very important that very few people are. I'm not seeing a lot of diagrams on this. This is uh, on payoff diagrams, and you can kind of use it in TWS, but it doesn't have the same specific systematic way of showing you break even and the strike prices. They're not overlaid together as well. But here I'm generating it as well, and again, showing you the spreadsheets. So those are the inputs for the different types of contracts, be it the Japanese yen, the natural gas, and these are soybean as well. So let me show you what I've built out now. So in here, everything is done here in my WSL Windows subsystem for Linux on Windows. And I've got all the different types of scripts I wrote, and I'm not going to release this to people at all. It's my own programming, but all the reports, all the output and images and charts that I generate, I'll make available. And as I said, because of what I just showed you in the prior video. This is very expensive stuff. So I'm trying my best to get it to the point where you can make some intelligent calls out of this. So what we're looking at here is I've built out a script that will run various examples of different payoff diagrams. So the payoff diagrams are pretty basic, but not exciting. But what I've got here is if I go into my charting directory here, we've got 4 different types of payoff diagrams which I can show. The first one is a basic one, and basically this is for natural gas now, what I'm about to show you. So this is standard, what a lot of institutions use. This is a payoff diagram of natural gas, a future versus a long call. So you can see here in the chart, we've got a futures payoff long call, and more importantly, we have the different break-even points for a call break-even and a future break-even as well. Now, prices and all that is just matplotlib, nothing fancy. I can get the accurate um, output of what these break-even points are, and anything above those break-evens will relate to profit. So as long as I'm trading within that range for both, if I do a long call and a future contract for the floor price, I can systematically make a risk-free trade by trading in both types of positions. That's what a lot of institutions do by hedging and arbitraging between that. And as I go along, I'll show some of the diagrams and how it's done. This is what institutions do, by the way. This is not really built for retail traders, because with retail traders, this is like very difficult to generate from a systematic point of view. So the next one we're going to look at is a soybean contract. So this one is essentially a little easier to pick up on, where you have your break even for your payoff, and then once you calculate your strike price along with your total payoff on that, you can start making profit. And by the way, this is unlimited profit as well. That's why this sort of trading is done, because there's a certain point you trade at, and as long as that price stays in place, you should be okay on the downside protection. But at the same time, with the call, you should be able to profit in an unlimited way. So that's just one example, and get a little more complicated. Again, this is for soybean as well. So you can trade stuff like this, um, and with that, this is all longing, because most of the time we will be buying into options, and on the flip side can be the sellers of the options. So the sellers will make money on the premium that you pay into to enter into this contract, I guess you could say, or position in an options for whatever you're buying. So again, this is for soybean, and again, same idea. We have a strike price premium, and then again, we've got our combined payoff here between a future and an option. So it gets much more complicated as time passes. And as I said, there's a more a golden area to trade in for both your entry and your exit, and it's quite literally a zero risk uh, strategy. And there's a bunch of combinations you can throw in there on top of synthetic, arbitraging, and hedging. That's what a lot of these firms do. The big firms in their big positions, like, could be a couple $100,000 per position, maybe a couple million per position, just depends upon how big they are. So that's with soybean. And again, what's going on here is we've got a long cash position uh, and a put option as well. And then lastly, what I want to show is a long yen put. And again, these are, there's all the micros that you can get the equivalent of as well. So you get a yen put option and potentially a future as well. I mean, these are just different combinations. So you can use these payoff diagrams, which not a lot of people use, on top of with the visual break-even points as well. So those are all important. And the other thing I want to show is the inputs that you get depending upon what you're buying or what you're interested in. And again, I'm going to have to manually feed this data. Um, if there was a nice way to run this um, with automation, I'd have to pay like thousands of dollars per month to get access to that data. I'll show you the difference. So just remember what I showed you with the Japanese yen payoff diagram. So here we've got futures entry, long call premium as well. That's again for the natural gas. So these are just different scenarios, obviously. Then again, we have the soybean 580 at a future entry, long put 575 with a long put premium of 7 cents. And again, I have to, for now, maybe three might be enough to showcase the different price points going out into the future. That's why I like doing futures and options because it's all built around futures and future prices, and all those options available through the option chain are set by the exchange, and then obviously the institutional players will uh, basically put investments on there where you get the bid and ask, as I showed earlier, reflecting on that option chain, which is very important. And then again, if you're afraid of the account size, you can always do the micro equivalent. So you can do a micro uh, Japanese yen, you could do a micro maybe soybean, and obviously the big ones that people like to trade are the micro oil, crude oil, or micro any of the market indices as well. So we have that in place. So one of the things I wanted to show you on the command line here is if I was able to get the data, again, paying the thousands of dollars, I could get access to the data, which this would pretty well typify a option chain that you would download or have access to through an API. So these are your long inputs for a T-bond, okay? And this is your option with a strike and the premium and all that. So I don't know how many data points there are, but imagine if you had access to that and you're willing to pay the thousands of dollars that I've explained in the prior video. Yeah, this is how accurate your predictions would be when it comes to the payoff diagrams. But looking at the payoff diagrams, if I was to run this particular one on, let me see here. I think it's this one. And remember, this is all in development. So let me just pull up one or the other of those two. Uh, yeah, here. Okay. So yeah, if I was to show these diagrams here, I want to show on these T-bond. Um, and again, this is what I like about options and futures. They're not correlated around each other. They're all uncorrelated, which is brilliant for when we go in. Well, we're already in bad times as it stands. So yeah, this is the one I want to show you. So here, with that data I just showed you, there is a huge difference on the accuracy you'll get on these different diagrams here. So, if you're looking at in green long put option payoff or the in purple here, doesn't look like it gets a long call option payoff, it's more accurate. So I'm not really guesstimating with three data points, but I'm using an actual data file. That's the difference between being able to subscribe to the data for the option chain data, as I've shown you at the beginning with Interactive Brokers TWS. You can get access to it, but you cannot do anything with it from a programmatic standpoint. I just think personally, I think Interactive Brokers maybe does it on purpose uh, to not make it programmatically available, or maybe it's just the CME and the exchanges telling them no, you can't provide that. I don't know what the answer is, but I think it's more the exchanges themselves that are hobbling the availability and accessibility to that data to the retail trader. That's how I see it. And then you have to move up into the very, very, very expensive data um, per month, as I've shown. So as it stands, I just want to show you yet again why this stuff is valuable what I'm doing, but it's also important to understand that this is why what I do will be expensive because this to access this type of data is not cheap at all. It's not like a couple $100 a month, it's a couple $1,000 per month. And as I said, you got to buy the full term 1 year of the contract. So it's at least anywhere from 48,000 to K a month plus 48,000 per year plus the licensing fees, whatever that ends up being. And yeah, it gets very, 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 very expensive. And then if you want to go to the unlimited, it's at 4,000 a month. So again, if you want to learn more about that, just go on my blog, look for this, how to gain programmatic access to options, futures, and other derivative option chain data. Okay. And you'll understand what I mean. And I have a video there as well. If you want to continue learning what I'm doing and at the same time getting your a free C++ HFT book on how the firms build these things, you can go here under the Learn tab, as I just hinted right here, and you get access to that. But I just want to show you how valuable this is. This is just the call payoff diagrams, which can be very, 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 very powerful for institutions that are trying to make these kind of position calls. And that's for the buyers of options at the institutional level. But there's also the flip side, as I said, for the sellers. And the sellers will generate their income from the premium that's generated from the buyers that are paying out the full premium for those positions. Anyways, we'll leave it at that. Thanks for watching. But just again, want to show you uh, how it works on the institutional front.